Well done, ladies. Bear with me, apologies. What are we looking at today? Today we are looking at market orders. When we're looking at market orders, it's important to identify how we can gain exposure to the market and how we can access the market. There's a couple of different ways to do it. A couple of different orders is what we call them. When you place a trade, that's you're placing an order into the market. I'm going to show you a quick diagram, a quick photo, and then I'm going to run you through. So all of the information to break everything down is in the course. I'll leave it in the link below so you can get a better idea, understand it for yourself. But I'm going to keep this video short and sweet, and give you a visual representation so you fully understand. So when we're looking at market orders, we're looking at usually three market orders. You have a market execution order, which is where you're on your phone, you see the prices entered into the zone that you want, and you press buy and sell right then and there. That order is executed right then and there into the market. That's order number one. Then we have what's called a stop order. So a stop order is when you want the price to come through. Say if you're trading below in a buy, you want price to come through your zone and then enter you into the zone, and you think price is going to continue up. And a sell stop is when you place a sell stop below where price is currently trading at, and then price comes down, enters you into a sell order, and then goes down. So if you think that stop is a continuation of a trend and a limit is a reversal of a trend. If you think that price is going to come down for a limit order now, so you have your market execution, number one, you have your stop order is number two, and then you have number three is your limit order. So your limit order isn't a continuation, it's a reversal. So you think price is going to come down, tap your zone and react. Or if you're looking for a sell, you think price is going to come up, tap your zone and react. So if we look onto the charts now and give you a better representation. So say for example, we have, here we go, boy. Let me set with a few examples actually. Excuse me. Here's our buy. And here's our sell. So now let's start with where we start. We start with the way you went. So market execution order, it's self-explanatory. We don't need to run through that. That's just when you're on your phone and you buy or sell and you market execute right then and there at the price that's currently displayed on your screen. And the next up we have a stop order. So stop order is when price comes through your zone, enters you into a trade, and then continues up. So if we were looking for a buy stop, we'd be looking for price to do something like this. Come through, break past our entry zone, and then continue to work our way up. That's a buy stop order. It's in continuation. And then a sell stop order would be the vice versa, the exact opposite. We think price is going to come through this zone, and for whatever reason, we're going to take our trade off of this zone, and we think price is going to continue in its downtrend. Simply put, that's all a stop, buy stop is. So this would be our buy stop going bullish, and this would be a sell stop going bearish. So no, it didn't mean to do that much. Now, if we have our limit orders now, our limit orders is when we want price to reverse. So we think prices that have been coming from a high, and we think price is going to come in. We want price to come in, tap down here, and then react, reverse off of this position. This is going to be your limit order. And then for your sell, you think price is going to be coming bullish, and then for whatever reason, tap into your zone, and then potter about for a bit, and then ultimately reject off your zone. So your limit order then is when you want the price to come down, enter into whatever your confluences may be, and then react. And then same again for your sell order. And the limit orders and the sell orders are good to have because, and the sell stops and the buy stops, they're all good to have because it takes the emotion out of the trade, and you're trading purely off of fundamentals or technicals. You're not trading how you feel in the moment on your phone, or oh, the price looks good, so I'm going to buy in or sell in right now. It's an easy way to take the emotion out of the trading, because you're trading. You want price to come to a certain level. You don't want to enter the price right there, because you may not be ticking all the boxes in your trading plan or whatever it may be. But it's important to also understand we have one more order, and it's a sell stop. A sell. Bear with me, I'm going to double check because I don't want to butch it up. Sell stop limit or a buy stop limit, it's called, but we'll double check. Yeah, buy stop limit or sell stop limit. So buy stop limit is when you want the price to do something like, so it's a buy stop. So you want price to come below and then break through, but you don't want to enter once this breaks. Why? Because you could get caught out on slippage. The buy stop, say if you enter a buy limit, buy stop limit, and you want the price to come through here, if price breaks past this zone really quickly, instead of you getting entered into your zone down here, you may very well get entered into your zone up here, which means you're either losing all of this as profit. And we don't want any of that, because that's taking out money out of our pocket. So what we do then is we set a buy stop limit. I don't really use them. A lot of people don't really use them, but it's important to know what they are. So buy stop limit will be price breaks through our zone. That's your buy stop being activated. Right. And now what's going to happen once the buy stop is activated, your limit order is then going to get activated. So if price comes back down, then your limit order will be activated, and then you'll be entered into the trade. So you won't be entered into the trade here the way you would with a stop order, but the stop order will initiate that limit order. The stop order will say, right, well, we're at the breaking past this zone now. So if we do come back down into this zone, then we're going to place our limit order. And then same thing again with a sell stop limit. Price comes down the way, breaks past our zone. Actually, let's just say, for example, just for sell stop limits. Say, for example, price comes down and massively breaks through here. Say if we had our entry here and price blitz through, like this a little bit clearer to see. We had our entry here and our price is either blitzing through, and we might only get entered probably again down here. And why do we not want that? Because we're moving out, we're missing out on all of this money in here, and that's called slippage. That's when you don't get filled at the order at the price that you wanted to get filled at, and price executes your order at the next available price, which is oftentimes leaving you in out of pocket or in drawdown. So then what price to do, once we break through this zone, that's your sell stop initiated, and that sell stop is going to tell your buy, or so your sell limit to kick in. So then if price does come back down, then your sell limit will kick in, and only after this move has already happened, because you don't want to get caught out on the slippage. And then you may very well go on to touch and take profit. It's important to understand orders in context of take profits and stop losses. Say, for example, we're in, so I hope that that's clear. If you look, this is just a short form video to get the visuals so you can understand the way it works. If you look through the course, I'll leave the link down below. Look through the course, read through it yourself, and you get a much better understanding of it. That's what these videos are made for, is to take the course content and use the video content and get a better understanding of them. So now, say, for example, we enter into a buy. So this is our buy, right? This X, when we X out of, don't stay with me because this might be a bit confusing. When we X out of market up here, this is our buy. So in order to get into the trade, in order to get out of a trade, we have to do the opposite of what we did to get into the trade. You know, bang, bang, bang. It's very important. In order to get out of the GTE, in order to get out of the trade, we had to do the opposite of what we did to get into the trade. Trade. Now, so let that sink for a minute. In order to get out of the trade, we have to do the opposite of what we did to get into the trade. So, for example, if we buy into our position here, when we get out of the trade, in order for us to get out of the trade, we must sell our position back to the market. So this take profit up here is actually a sell limit. Why? Because this is a price at which you want to sell your order back to the market. So it's not a sell limit as a price where you want the price to come up and then reverse, but it's the same concept. You want price to come up and take you out of the trade. So this, your take profit in a buy is your sell limit. And then your take profit in a sell, for example, if we get in here, your take profit in your sell is going to be a buy limit. Why? Because you have to do the opposite of what you did to get into the trade to get out of the trade. So if we sold into a trade, we need to buy back our position. And if we bought into a trade, we need to sell back our position. So we have labeled this now for you. It's nice and easy. That's your sell limit. Why? Because you bought into the trade, so you have to sell back out of your trade. And then this is going to be your buy limit. Why? Because you sold into the trade. So if you sold into the trade, we have to do the opposite of what we did to get into the trade, to get out of the trade. So now when we buy into a trade for our bullish scenario, our sell limit is our take profit. And then we sell into a trade, our buy limit is in essentially the order that's used to take us out at take profit. So now if we get rid of this for a minute, if we can, get rid of that. Say, for example, we entered into a trade and it does that. Well, what's that? Well, if this is a sell limit order, well, then this must be a sell stop order. Why? Because it can't be a buy order because we bought into the market. So you can't buy into the market and buy back out of the market. It's not how it works. So this is going to be your buy stop order. You don't have to think about it too much unless you're trading. It's really important if you're trading futures because it doesn't actually give you a take profit or a stop loss order. It's if you're buying into a trade on futures, you have to sell limit out of that trade or sell out of that trade. If you have 10 contracts open when trading futures, don't think about it too much, but it's just food for thought. If you're trading futures, say you're trading 10 minis, 10 micros, in order for you to take profit, you have to sell 5. So you have to sell 5 micros, place a sell order into the market in order to take you out of the buy order that you're currently in. When you're trading futures, you can't hedge your bet. Hedging your bet just essentially means you can't go in both ways. I can't buy into a position and sell into a position with futures the way I can with CFDs. Just feel for thought. Don't think about it too much. Don't get confused. Don't dwell on it. Just have it in your head so you understand it. This here now. This is going to be that's going to be your sell stop. So if we bought into a position, this is going to be our sell stop. Why? Because we can't buy into a position and buy out of the position. So if we bought into the position, if we hit take profit, that's going to be our sell limit because price is coming up and we want to take us out. And if we hit stop loss, well, then that's going to be a sell stop because you can't buy stop. It doesn't make any sense. You have to do the opposite what you did to get into the trade in order to get out the trade. So now if we take this, for example, and say happy days, and then bang. To get out of that trade, our stop loss order is a buy stop because you sold into the trade. So we have to buy back our position at a loss. And we bought into the trade in this scenario. So we had to sell back our position at a loss. I hope you understand that. And I hope you stuck with me with that because it's important to understand that you don't have to think about it too much. Don't dwell on it too much. Don't try to take in so much information that you start the analysis paralysis, that you start just overthinking everything. Oh, what's a buy stop? What's a sell stop? What's my stop loss? You don't have to think about it, especially with CFDs. You don't have to think about it because it's just labeled stop loss, TP. Couldn't be more simple, but this is just what is actually going on behind the scenes when you do take a trade. That's all the limit orders. That's all market orders for us. So that is the end of the video, and I will catch you in the next video. Make sure to look at the course down below, do your study, take your notes, and any questions that you have, fire them away, no problem at all.